At the New York Stock Exchange, where we are going to see how the markets react to President Trump's trade war with China. They skyrocketed yesterday, but right now, as of 8:30, the opening bell, the market opening down 686 or so points. Of course, as always, changing, down 1.6% so far this morning. It has certainly been a tumultuous number of days for both the markets and tariffs. Here, for some more perspective on all of this, is Chief of Staff at Stanford Institute for Economic Policy Research and former economist for the Joe Biden administration, Ryan Cummings. Ryan, thanks so much for joining me this morning.
Thanks. It's great to be here.
First off, what is your reaction to what's happened, and there's been a lot that's happened over the past couple of days, and the fact that the markets are opening down, at least so far this morning?
Yeah, so this is something we tend to see whenever we have really big giant swings. So yesterday we saw the third highest return in any given day since 1945. The first highest, though, was October 13th, 2008. Now, what you saw actually 2 days after that, on October 15th, 2008, was the market had its fifth worst day since 1945. So stocks opening down today isn't necessarily a surprise because they went up so much yesterday. Last week, between Thursday and Friday, they had their fifth worst performance since 1945 in a 2-day window. So we're seeing a lot of swings, and it seems like today maybe the market backed off some of the optimism that it had going into yesterday's close, because the average effective tariff rate from President Trump's tariff proposals only really dropped about 3 percentage points, from 30% to 27%. The Chinese tariffs increased, as you know, from 104% to 125%, and there was still 10% across the board tariffs. So even though there was a pause, we're still seeing some pretty extreme heavy burdens, and I think the market might be waking up to the fact that a lot of the toothpaste may not be able to be put back in the tube.
You know, some people waking up at home right now maybe don't own stocks. They might not have a 401k and may question whether all of this really impacts them directly. So why should they care about what we're seeing right now and what's been happening over the last week or so?
Yeah, absolutely. So typically, small variations in the stock market day to day, as you implied, do not really affect people's lives. But whenever you have these big sudden drops and reversals, what happens is companies start to get more uncertain about the future. So they're going to stop doing new investments. So that might be stop building a new factory. They might stop hiring people, because effectively they're looking at the stock market and they're seeing that as an indicator for the future of the economy. And they're seeing just crazy movements. And they say, I don't know what the future is going to be like in 6 months, and I don't want to invest a lot of money today. So in 6 months, if there's a recession, there's not demand, and we're going to be losing a lot of money. So companies tend to hunker down. And you can see, for example, the CEO of Delta just recently said the uncertainty caused by the tariff wars was weighing on their sales. So you can see this across a lot of different industries, whether that's surveys of consumers themselves saying they're going to go out and buy less, which creates less demand for a product, or from firms saying that their investment and hiring plans are decreasing over time. So even though it doesn't necessarily affect you if you don't have a 401k on the day-to-day, these are kind of longer term, 6 month, 1 year, 1 year and a half kind of windows that we're looking at where they really start to matter.
Kind of going back to something you just touched on, JP Morgan Chase's CEO and other financial leaders say a recession is increasingly likely. Americans, you know, as you talked about, have had to bounce back from at least 2 major financial crises over the last couple of decades, 20 years or so. But, you know, our allies worked with us. We worked with them globally to get through those downturns. There's some isolation happening now because of these tariffs. So how will the potential lack of international cooperation change how we potentially recover or make any gains moving forward, if at all?
Yeah, so this is kind of a broader problem with the trade war. As time has gone on, the economy has become more and more interconnected between different nations. So these are kind of global value chains of maybe you put a factory in Mexico to assemble one part of a car, and then there's another factory in the United States which puts together the final assembly of the car. So whenever there's a global recession, you know, countries might band together, kind of try and do stimulus in a kind of complementary way. Or, for example, the Federal Reserve has something called a swap line, which effectively allows our central bank to lend other countries' central bank money so they can kind of lower interest rates and help boost demand. And if you think about our export markets, that's going to be really important to make sure that those other countries can also have a robust recovery. So in this sense, we've kind of reversed the picture. Now we're saying, as you said, we want to be more isolationist and we want to try and, either go through a recession alone and come out of it alone. I think it's a lot easier to go into a recession alone than it is to come out of one alone.
So obviously, I mean, things keep changing almost by the hour right now, Ryan, so we'll have to see how this all plays out. But I really, really appreciate your insight. Really interesting to talk with you, and I hope that we can chat again in the future.
Absolutely. Thank you so much.
All right, Ryan Cummings, thanks again.